Today we are going to be looking at debt, whether it's good or bad, how to manage it, the different types of debt, all of that fun stuff. I'm Jolisa Gonzalez and this is Sam Hilal, and today we are going to be exploring all of that fun stuff. So we looked at the different variables of mortgage loans and HELOCs. Now let's transition a little bit to a different field, auto loans. What are some pros and cons on taking out an auto loan versus just buying the car outright?
First, let's look at it from the lending institution's perspective. We talked about HELOCs and mortgages, right? In those cases, the lending institution is utilizing the house as the collateral. In their mind, if you default on the loan, whether it's the mortgage or the home equity, they can go in and foreclose and take the collateral, take the house, and they can sell it, right? So their risk tends to be lower than that if you're using a car as a collateral. So what happens, a car typically depreciates. We've experienced most of the time house values appreciating over time. Yeah, there will be some periods of time where they may drop in value or maybe based on certain economic parameters. But for generally speaking, most of the time, the value of homes appreciate. That's why that tends to be the lowest risk to the lending institution. But if you're using a car is typically a depreciable asset, right? So it tends to lose value over time. That's why the lending institution is going to be taking on a lot more risk. So what they do in this case is that they typically will charge you a higher interest rate on the loan, and they would also typically shrink the time of the loan, the term of the loan.
So based on your response to my question, are you saying that we should always borrow then?
Not necessarily. This is where you would go back and look at the spread again. Is the spread in your favor? For example, in today's environment, there may be some automobile companies that are trying to promote their automobiles. Maybe they've experienced a lower sales of their automobiles, and they're trying to promote a new line or whatever. So let's say, for example, XYZ company is running a promo that if you buy this car and you finance it through them, they will give you 0% financing for 3 years, or maybe 1% financing, or 2% financing, right? So this is where you look at it and say, okay, well, if I have enough to pay for the car outright, and that money, let's say it's sitting in my savings account or in a CD at the bank earning somewhere between 4 and 5%, and I have the option to borrow the money at 0% or 1 or 2. In this case, the spread is definitely in your favor because your money is making somewhere between 4 and 5%, and you're able to get the car, and it's only going to potentially cost you either nothing if it's 0% financing, or maybe only 1 or 2% per year. So in that case, even if you have the money, it would make sense for you to borrow it because of the spread is definitely in your favor.
With interest rates being so high, a lot of people are trying to switch gears and look at leasing. Can you explain the financial implications of leasing versus traditional financing a vehicle?
Yeah. For some reason, leasing tends to be this vague concept to many people. The easiest way to think of leasing a car is effectively like you're renting the car, but you're renting it for a long term. So it's a long-term rental of the car. It's never yours. You don't own the car. The dealership or the manufacturer or the lender continues to own the car. They're just renting it to you for the interim, and you're responsible, obviously, for anything that happens to it. But with the rental agreement, when the lease is calculated, let's say, for example, they're going to lease it to you for 3 years. So they take the current value of the car, if you pay cash for it today, and then they estimate what the residual value for the car will be 3 years from now. So let's say it's worth $50,000 today. 3 years later, based on their calculation, it should be worth $30,000. So effectively, there's $20,000 that you're going to end up paying over the next 3 years. But also, that's not for free. So they're going to charge you interest on that $20,000 that effectively they're lending you under the lease agreement. So interest rates, if they're high, that would also affect the lease, and the lease would still be high, which means your monthly lease payment will be high. So interest rates do affect the cost if you're buying as well as if you're leasing the car.
Okay, now we're done talking about auto debt. Let's transition into talking about student loans, something that probably everyone has, everyone wants to avoid, but for some reason it seems like there's no way out of it. How should families approach borrowing for education?
Sure. Well, as you know, Jolisa, the subject is very timely for me as I have a senior at home, and she is looking at going to college starting in the fall. And we certainly look at all of these things. In my opinion, this is my personal opinion, education is probably the most important gift that any family or any parent can give to their children. during their lifetime. It's more important than what you do at Christmas. It's a lot more important than what you do for their lifestyle, because this is the old adage of, hey, do you give them fish or do you teach them how to fish? Providing education or helping them in their educational journey is effectively teaching them how to fish and how to be able to generate income for themselves in the future. But just like any borrowing decision, believe it or not, it always ends up looking at the basics when it comes to borrowing. Are you borrowing for the right reasons? Well, we know education is important, right? But what is the collateral in this case? What do I really mean? So let's say I am interested in going to college and learning, majoring in nursing, for example. I can go to a private school that may charge me $70,000 to $80,000 a year in tuition and fees to learn nursing, or I can go to a school where the tuition and fees are only going to be $35,000 a year. Ultimately, yes, maybe this school is more prestigious, and it may be open additional doors in normal circumstances. But as we know, nursing is a very hot or very sought after field. There's always a shortage in nurses. So whether you're paid $70,000 a year for your degree or $35,000 a year for your degree, more than likely you're going to compete for the same jobs everywhere, and you are going to be receiving the same type of salary, right? So does it make sense for you to pay the extra money and borrow for that? That's where I say look at the collateral, which in this case, the degree that you're going to end up with, and evaluate it that way.
Okay, say that we looked at the collateral, we picked the school, now we're at the process of taking out the loan. Many people have these two very common options, subsidized and unsubsidized loans. Can you explain the difference of those? Because I feel like for many college students especially, they don't even know what they're signing up for.
When you ultimately decide what you want to major in and you ultimately pick the school that you want to go to, most of those schools, what they're going to ask you is to start by going through the FAFSA process. The FAFSA is an application that is run by a federal government agency that effectively asks you a lot of questions about your financials as a student, as well as your parents' financials, and gathers all this data. And then the schools that you are looking into will have access to that data, right? Effectively lay it out in a way that they're able to make apple-to-apple comparisons. And based on the FAFSA, the schools then they can come back to you with a package. For example, they can say, hey, you qualify for this scholarship based on your grades and based on everything you presented us. But also based on the FAFSA information, you qualify for these types of loans. Some of them may be subsidized in your case. Subsidized is when the government is guaranteeing the loans, right? So again, we're talking about risk. So in this case, XYZ Bank, the lending institution, because they have a guarantee to this loan from the government, then they're not taking much in the form of risk. So they can lend you that money at a lower interest rate versus an unsubsidized loan where the government is not guaranteeing that loan, and effectively there is no collateral. You know, the bank is not going to come in and take your degree afterward and sell it to somebody else, right? So this way, the unsubsidized loan in this case would be a much higher interest rate if you take it than a subsidized one. So typically the school would come back and say, all right, here's what we can offer you in scholarships. You also have the ability to go out and borrow this much of it will be subsidized, this much of it will be unsubsidized, and then you make the decision what you want to do. So a lot of the subsidized loans, typically, they do not start accruing interest until you are done with your degree. So if you're studying for 4 years and you're starting to borrow from day one, then effectively that money is not accruing interest until after graduation. And some of them give you a certain grace period after graduation to get a job, versus unsubsidized loans where they start to accrue interest from the day you borrow them.
So since we're on a topic of talking about student loans, can you tell everybody about that one client story you always tell me about?
You might find this relevant or not, I'm not sure, but I had a client who had a daughter. She wanted to pursue dentistry school. And so her schooling was 4 years of undergrad, and then she had to find a placement into a dentistry school, and then she spent 4 years in dentistry school. So her total schooling was something between 8 and 9 years. And he insisted from day one that he was not going to be paying cash for her education, that she was going to be borrowing 100% of the cost. Now, he happened to be a well-to-do person, and he had plenty of money to pay upfront in cash for her schooling, but he chose not to. But she went through it. She finished her undergrad. She went to dentistry school. She found a good placement. She went for 4 years in dentistry school, and she graduated. And on her graduation day, her dad comes up and gives her a hug and hands her a check for 100% of the cost that she borrowed. And he said to her at the time, I had no intentions of ever having you pay for the school. I just wanted you to know what your education cost was. And if you're the one that was going to be on the hook for paying it, then you would look at it and evaluate it very differently versus if somebody was just writing checks on your behalf. And I always found that story to be very fascinating and truly presented a way that people should understand the value of their degree and their education.
Honestly, that idea is genius because as someone who had to pay their way through college, I took it very seriously because I don't like wasting my money. So I think more people should do that little trick on their children just so they can maybe work a little bit harder in school. So the whole entire college process is very stressful between picking the school, determining which one you can afford, how much money you should take out. Can you tell them a little bit about the software you use to help them out with that?
Sure. So I subscribe to a service. It's a software service where we take a lot of input points and data points. I used it myself on my child's process of identifying the various schools. But the service effectively helps those that we're utilizing in determining which schools make sense for them. So based on the input that we put in, the report that would come out would actually identify a couple of schools, 2 or 3 schools that would make sense from a financial perspective, in the sense that those schools tend to offer scholarships, and we would identify certain scholarships that are available through those schools, and so on and so forth, for that specific field that the student is interested in pursuing. So it's a very cool service. This is something that we can offer to our clients, and obviously anybody who's interested in that in the future.
I was take him up on it. So if you're a student with no money, you usually go to your best friend, the credit card. Unfortunately, a lot of people get into a lot of trouble with credit cards, but I feel that credit cards could actually be a very resourceful tool, and you could actually use it to your advantage. What are some ways that you use it for your advantage?